and looking at the stock market and seeing what's been going on and where there is opportunity, also how we can manage risk in our portfolios. And if you're new to my channel, I've been investing for a long time, managing a portfolio. I really enjoy stock investing. And this year in particular is a challenging one. We've got stocks that are selling off. This is today's heat map, and it's a pretty rough one. If you're in some of these red spots, totally understand it was a rough day. Investors moved into safer stocks and consumer staples, utilities, and our friends over in energy. They picked up a lot of investors who believe oil prices are going to stay high. So they wanted to buy some Occidental Petroleum, some Devon Energy, and I can't blame them. I think oil prices have really gone up. There's instability in that commodity, and it's probably going to make for more expensive per barrel prices, and it just makes these companies more profitable. They have very well established businesses. Some of these businesses have been around more than 100 years. Their operations are set. They don't have to think about it. They just produce oil. And if the market's going to pay them substantially more, because oil went from less than $60 per barrel, and now we're above $90 per barrel. That's in effect a 50% increase to the price they get to sell their oil. That is a very, very good situation for these energy companies. It's a bad situation for the rest of the economy because it really dries up the disposable income that these consumers would have spent on consumer discretionary items, experiences, travel, and that oil also is an input cost for other businesses. So you see businesses in industrials and other industries get affected. So it's going to affect the whole economy. The last time we had oil prices at this level was at the beginning of 2022. 2022 was a terrible year for stocks in general. Some stocks did okay. Energy that year was probably the best sector because it had high oil prices. Well, this year, it's not a perfect carbon copy of what we had in 2022, but it's reminding me of 2022 because the high oil price was established early in the year, and it led to a terrible stock year, and I think unofficially a recession. We were dealing with COVID. We were still dealing with COVID in those days, so we had that mixed in there. We are now dealing with a war. We're dealing with high oil prices. So what is going on stock market? Now, I mentioned oil prices. So let's take a peek at where those oil prices are, and I'll show you the example. So this is oil prices, 5-year chart. And I'm not going to turn this into a 1-hour economics conversation. I just want to point this out. Last time we were at this price level, 2022, we stayed at these levels for a little while, probably about 6 months. And that really added a lot of cost. And FYI, that's the time when inflation started going just crazy. We had really high inflation. We had people really struggling to get by, just a lot of bad things. We just got to these high oil prices. We've been in this high oil price position, for a couple weeks. Let's take a look at it. So I'm going to change this to the 1 month. And we got above $80 per barrel starting on the 4th of March. We are at the 12th. So we're 8 days into this. Now, instability is here to stay for at least a couple months within oil. But as you saw over the weekend, oil prices could really spike at any day. They can go up. The situation from a war perspective, it's not pretty. A lot of ships are being attacked. Um, and that's going to create more and more concerns, fear, and volatility. So this is really the biggest story of the year so far. Of course, the war is the big story from an economic perspective. How it's driving high oil prices is a byproduct of that war. So this high oil price is really going to affect the market. So as an investor, I'm looking at it, trying to navigate and trying to get through this year, accomplishing a couple of things. First is how can I limit the losses, reduce my risk? And second, how could I buy certain stocks that are going to be worth a lot more in a year, 2 years, 3 years? Because in 2022, you could have bought some terrific businesses at a great discount. So let's not lose sight of that. We look at the year to date, we've got some businesses that have been under a lot of pressure. Software has just been getting smashed year to date. And if I look at the 1 year or even the 2 year, software is doing real bad. You see Adobe's down 37% 1 year, ServiceNow 30%, CRM Salesforce down 28%. So these are just really, really bad numbers. And the pain continues. I listened to the Adobe earnings call. It was still going on when I started my live stream. They were going a little long. And that stock's under pressure. I'll talk about Adobe in a few minutes. So I'm going to leave that kind of in the back burner for now. Over the 1 year, some stocks have worked quite well. Google's worked for the 1 year. NVIDIA, of course, Broadcom. Micron's been just a terrific stock. AMD up 104%. Congratulations to AMD stockholders. That looks terrific. Palantir up 96%. And look at this. The semiconductor space is just really cleaned up. So the data center is obviously the place where there's been a lot of outperformance. Tesla's up. That's an incredible 71%. It's probably the compare that's making that look great. And even energy's looking good over the 1 year because the year to date is so darn terrific for energy. Energy's looking really good year to date. And if you look at these smaller caps, they look terrific. You got 84% gain, 42% gain year to date in 2.5 months. COP, 28% gain. The big guys, CVX, Chevron is up 29%, and then ExxonMobil is up 27.5. So that's where stocks are gaining the most in general. Micron's still working year to date. Intel's working, and some technology is still working. We've had a couple of earnings. I've got 3 stocks on my list that I wanted to cover. And I welcome you to put a stock that you want to cover in the chat. If you're a member of the channel, that's part of your perk package. You put a stock in the chat. I'll look at it fundamentally. We'll see if it's valued at a discount or at a premium, and just give you some general comments. None of this is ever advice. It's just one stock investor researching and sharing research. That's what I'm doing. I hope it's interesting, and I welcome comments, questions. If you're not a member, no big deal. You're welcome to attend. You're welcome to use the chat. If you'd like me to look at a stock and you're not a member, pay a $5 super chat fee, and I'll take a look at your stock. You can also become a member on the fly. It's easy, and it doesn't cost a whole lot. So thanks for joining me. We got a good number of people on the stream. I appreciate it. So let's get to it. Let's start taking a look at some stocks that announced today. We're going to start with Adobe. Adobe's fresh on my mind. Looks like Peyton is on. Good to see you, Peyton. You are a regular, sir. Good to see you. And Adobe has its stock price going down, and it had the CEO announced that, hey, he's retiring. He's been there a long time, by the way. He joined Adobe in 1988. He's been CEO, I think, for like 18 years. So it's not like, hey, this guy's, been there a few years and now he's leaving. Nope. He's been there a long time. Maybe he wants to retire, go live on a ranch somewhere or something. So he announced that. And the sell off, I think part of it is that CEO news. The fundamentals look really good for Adobe. They are doing their part to show that, in this AI era, they continue to grow. They actually accelerated their growth. That's what I want to see. So they were growing at 10%. They're a pretty good sized company. I'm looking at the quarterly income statement, looking at the top line of growth, right? A business that continues to grow the top line shows that customers like the product service. They can increase prices. They're going into a market where there's new customers to be gained. All those things are positives, real positives. Adobe showing us that they're growing consistently by more than 10%. And in the quarter they just closed and reported, they grew almost 12%. That's really good. They're doing their part to show that the AI thesis, the story that AI is going to come in and replace or maybe weaken these companies, these software companies. So far, I don't see weakness in the Adobe business. That's the top line. Now let's see if these guys are profitable. And I know the answer, so I'm leading the witness here. When we look at cash flow, the cash flow growth for Adobe is excellent. Look at this chart. That's a beautiful chart. Real nice upward slope. The trajectory is awesome. Nicely done, Adobe. So this is a business that's growing more than 10%. It's growing 12% if you look at the last quarter. Generates really high rates of free cash flow. And it does because it has a very high gross margin. Adobe's a software business focused on the creative arts and creative aspects that we do now that we live in a digital world. Their profit margin is 29.5. And if you follow the rule of 40, you take profit margin plus growth, and they grew at 12%. So they get to that rule of 40. So that's good. That's really good. It'd be nice if they were like more around 50, but hey, this is a good business. They got really good gross margin, really good profit margin, and the free cash flow margin, 42%. So just a really, really good, valuable business. If they continue to grow at 10 to 12%, it's just going to be proven that, hey, their business is not being disrupted by AI. And at some point, I would have to think that investors are going to get into the stock. Now, I would not be surprised if tomorrow stock goes higher. Now, we are dealing with a down day overall. Showed that when I started the stream. Stock market was down today. The news of the CEO moving, that's always a reason why some investors would sell a stock. Understood. I understand that. But we'll see what happens tomorrow. The balance sheet is solid. They have just as much cash as they do debt. So there's no big debt problem there. And overall, their forecast, let's take a look at that. It's important to see what's ahead for Adobe. Are they going to be doing well? Are they going to be in trouble? Analysts think there's a big discount available on Adobe, 46.58% discount. When we look at the forecast, we are in the year that's going to end November 28th, 2026. That's in 6 months. And the company is growing at 11.7%. Next year, their fiscal year that ends November 27, they're going to grow at 9%, 8%, and then 5%. Now, this is a little concerning. 5% growth, that kind of supports the narrative that what's going on is AI going to hurt these guys. So it needs to be Adobe's mission to outperform those numbers. Those numbers do concern me a bit. 2 years out, I guess 2.5 years out, if growth slows down, boy, it's going to be hard to convince the market that AI is not disrupting them. So that's a negative or a yellow flag that I would put on their fundamentals. Earnings per share is growing nicely, and their forward PE is really coming down. It is fairly incredible how their PE ratio is coming down. One thing I had to adjust, I'm going to show you my valuation on Adobe. When I ran the valuation on Adobe, I had to move the share count because they've been buying back a lot of shares. That's a very good thing. Overall, creates more value for the shareholder because remaining shareholders own a bigger percentage of the company. So I had to change my shares outstanding by about 5% lower, which is a good thing. Overall, this is a highly discounted stock. The free cash flows are worth a lot more than its current stock price. The value of its profits higher than the current stock price. It's not a valuation problem. It's a big picture problem. The market thinks that software companies like Adobe, like Salesforce, ServiceNow are going to be hurt by AI. That companies can come in and write software far easier, quickly, and begin to compete against Adobe. I think that's a rational thought. But let's kind of go back to some of the reasons why Adobe's successful. First, the brand. Their company's doing well. As we look at the Adobe business, there's professionals that are working with Adobe products. They've worked with that product for 30 years. It's what they know. It's what they use to create, the product, the services that they provide. So I think that is worth something. The brand, the network, that in itself creates a moat because somebody else could create a product with AI, or maybe in a current company, the competitor of Adobe can make their product better using AI. I'm not going to argue with that. But Adobe's doing their part of using AI and providing a new product set. On their earnings call, they talked about Firefly, and they talked about it quite a bit. It is one of the key product lines that they have. And Firefly is an AI application. It enables people to create graphics, images, and things of that type. And that should be something that the company really focuses on so they could deliver AI experiences to keep them relevant in the marketplace. So overall, I thought the earnings were really good from a fundamental perspective, but the market is still not completely convinced and is not buying software stocks, long-term wise. Software stocks had a nice 2-week run, not this week, but the 2 weeks before our current week. We saw software stocks do quite well. And Adobe did pick up some new investors in that time. We'll see how this trades tomorrow. I'm not sure what's going to happen tomorrow. We've got this war going on. We've got high oil prices. Today was a crummy day. It was a big sell-off day. And tomorrow, I don't know if we're going to have another crummy day, but if we don't have a crummy day, I wouldn't be surprised if Adobe trades higher than where it's at now because the earnings were good. All right. Looks like a lot of people are joining the stream. That is great. It looks like Peyton has been in. He's already announced his presence. Good to see you, Peyton. Futu's on my list, Peyton. Yeah, wasn't that amazing? I'm going to go over Futu in detail. I just covered Adobe. We're going to take Futu for the full tour. Stand by. That's already on the list. Ricardo, how are you, sir? Let's look at KRYS. It is on the list, sir. Comment from Peyton Software. I know. It's, at some point, I think it's going to turn. And the software companies that are going to do well going forward, and it is, determined or confirmed that no, those businesses are going to do great going forward. Those are the stocks that, man, I really want to keep a close eye on. And I already own some software stocks, but once the market turns, I'm going to be a buyer. That's my job, is to find opportunity and then buy at the right times. Mohammed, good to see you. You're not touching software stocks. I own them, but I'm not buying more, so I understand the feeling. Ben 10, how are you, sir? I'm doing well. It is going well. I'm looking for opportunity out there, Ben 10. It may be opportunity that I'm not going to see the big payoff for a year, maybe two. But boy, I see a lot of good businesses priced lower. And I think it's going to be a good year to buy. It's going to be a good year to find good value. So Ben 10 wants to look at ACI. And you want to look at, is that LT? Is that the private equity company? Blue Owl? Probably not. Blue Owl's really been under pressure. DJ, good to see you. I think if I recall right, DJ, you're in England. Appreciate you staying up late. So, DJ, you want to look at CALM? Glad to, sir. Boy, we've got a nice list, everybody. This is the list. Baby monitors. Cool. Nice. All right, we'll take a look at that stock. We've got 2, 4, 6 stocks on the board. We got BBWI. Mike, the dividend investor guy, asked for that. We got Futu, KRYS, ACI, OWLT, CALM. Let's get into it. And DJ, I was wrong. You're East Coast. Got my wires crossed. Well, thanks for joining. Great to have you. All right, let's get into it. Let's get into Futu just to keep things rolling. So Futu is a brokerage business. Think of Robinhood, and you've got kind of like the business in mind. The difference is Futu's headquartered in Hong Kong. So a lot of people are saving their money in Asia, and they're investing in stocks, and they probably use Futu. And here in the US, you would know them as Moomoo. If you're familiar with that brokerage, Moomoo is offered here in the US. In Hong Kong, it is Futu. And Futu's been a good performing stock overall. They announced today, that's what I'm going to cover, but just to give you a quick tour. Over the 1 year, they're up 29%. It's been going sideways, but you had an opportunity to buy the stock at a really nice price, $75 per share back in April. And over the last 5 years, I started buying here, so I'm doing well. With the stock. And this stock is growing really well. The company is $19.9 billion market cap. Forward PE is only 12. Strong buy with a 45% discount. This business is growing and growing substantially. 76% growth in the full year 2025. 53% growth in that last quarter. Overall, this business, they produce good cash flow and good profits. I'm going to be updating my valuation, with the new numbers. It looks like for the full year, they grew at 86%. And the year we're in, 2026, it's expected they're going to grow by 15%. and then 14.6. They are a pretty good sized company already, and their P ratio is dropping. So taking a look at their earnings, let's take a look at that together. And I'm going to open up their investor page. So bear with me here. Here we go. Q4 wasn't listed on their quarterly results, but here it is. So here's their fourth quarter and the full year for 2025. So funded accounts went up 39%. That's good. More account holders, new customers, organic growth. Very good. And then brokerage accounts went up 29.8%. Okay. Total client assets increased 65%. It's very good. Getting into revenue for the quarter, revenue increased 45%. Gross profit increased 56%. Net income really went up 80%. Total revenues for the year, 68%. So these are really good growth numbers, right? I was showing Adobe earlier in the stream. They're growing at 12%, and then it's expected they're going to slow down a bit to single-digit growth. And now we're looking at Futu. These guys are growing by big percentages. So that looks really good. I believe that's faster growth than our friends over at Robinhood. Robinhood may be a little bigger than these guys now. So the top line growth looks really good. Now let's take a look at their financial statements and start dissecting those. Okay, so on the balance sheet, they've got, this is the cash line we're going to focus on because this one here, this is client money. We don't want to consider that. So they have $1.3 billion of cash on the balance sheet. Okay. Liabilities, they've got $1.5 billion of debt. They've got a little bit of net debt, about $200 million of net debt, which isn't all that much. So that's good. So we went over top line growth. Now I'm going to go over their earnings per share in stock analysis. Now they didn't give me a statement of cash flows here. Let's see if they're going to provide it here. So here's the balance sheet. Balance sheet continued. Comprehensive income. Now, they didn't provide a statement of cash flows. All right. So we'll have to work around that. So cash versus debt, we had $200 million net debt. Now let's take a look at the forecast and look at the earnings per share. I'm going to be updating these numbers in my valuation. Now, I'm going to use the earnings per share that we expect in 2026. This is in the Hong Kong currency. So I'm going to have to convert that from HKD over to USD. So no big deal. We can do that. All right, let's get to work here. Let's update Futu. Let's update the valuation. What kind of valuation am I running here? So I'm valuing this stock based on the future free cash flows of this business. At the end of the day, that's what we care about. Long-term investors is the future cash flow this business is going to produce, as well as the future earnings per share. So I'm going to open up a screen you guys can't see. It's stuff that we just reviewed together. And I'm going to start updating some numbers, starting with cash flow. Now, the cash flow for this business, it's not being reported for the current year. So I'm going to have to wait on that number a little bit. I have an estimate of $1.5 billion. I think that's reasonable. Their cash versus debt changed a little bit, not too much more, but let's get the most recent numbers in here. And then the share count, let's take a look at that. That looks correct. So overall, and maybe the growth is a little bit too optimistic there. So we're going to change these down a bit. We're at a 46% discount based on the future free cash flows I expect from Futu. Now, projecting the cash, I've owned Futu for, call it a year and a quarter. I've analyzed the company for about a year and a half. So a lot of this work is kind of a continuation of the work that I do from quarter to quarter. I'm using a higher discount rate because Futu is located in Hong Kong. I'm in the United States. So I increase the discount rate when I'm investing out of my home country. And I think Asia is terrific. I think their economy is growing fast. I just don't have the kind of visibility, familiarity with that region. So I'm going to have a higher discount rate. That in itself covers a little more safety, margin of safety. So overall, 9% discount rate. Now let's take a look at the earnings per share. See what that is going to look like for 2026. All right, so this is where we're going to have to convert the HKD to USD. What is that conversion? 0.13. All right. So we're going to go 91.74 times 1.3. And our earnings per share, 11.93. A P ratio of 18. I think that's reasonable. Growth rate of 10%. That is also reasonable. So I agree with the analyst. This is a discounted stock. It's a discounted stock. And now, big picture. Let's talk about big picture with Futu. I like buying Futu because I think the region of China, Japan, Korea, Taiwan, Singapore, those countries are really growing well. I think they're going to keep growing. So I'd like to have some of my portfolio invested in Asia. So I own Futu, I own Alibaba, and I own an ETF that owns or is invested in a really good selection of Chinese and Asian stocks. So this is a stock that I really like. I like these businesses. They don't require a lot of capital. I think in the current time, there's more investors, retail investors joining us as we grow our wealth, grow our portfolios. And I think Futu is a terrific company. So I'm going to stay invested in Futu. I'm even going to buy more shares. If the market's going to sell off the stock, I'm going to buy it. I'd like to increase my Asia position. And I think China had a report early this week where their exports increased by 22%. And China is a massive economy, huge. They grew by 22%. That is mind-boggling. That's a lot of growth. So the whole region's doing really well. The Korean stock market's been doing well. Japan's doing well. So I'm good investing in that region. It's not a big position. Let me take a peek and see what kind of exposure do I have to Asia. I have 5.18% of my portfolio in China stocks, Asian stocks. I can increase it, maybe 7%, because I think that region's going to do really well. Most of my stocks are going to be in the U.S. I'm in the U.S., and that's fine. So I think Futu put up good numbers. I really like their growth, and I think they're going to keep growing because I know we're dealing with this war with Iran. We're dealing with some headwinds, but I don't know that China and those countries are dealing with much of these headwinds. We talk about data center. A lot of the stuff that's going in that data center gets manufactured out there. Taiwan Semiconductor, that's huge manufacturer. A lot of the memory that we are short on, it's coming out of Korea or China, and it's getting manufactured out there. And some of the companies are located there. Samsung, a big semiconductor company, as well as big electronics powerhouse. So there's just, I can go down the list of these awesome businesses, and their economy is doing quite well. So I'm good investing in Futu, and I can update my analysis on Futu. And FYI, if you're a member, an advanced member, you get access to all this research. And I've got over 380 companies evaluated on this spreadsheet. It's a Google sheet. You get access to it. So if you become a member, you get access to this. Keep that in mind if you want to become a member. You just have to be an advanced member. Or you can be a super investor member too, which is more. And as super investors, you get everything I provide advanced members, plus you get to see my portfolio. I create super investor videos, a one-on-one call every month. There's other things that come with that type of membership. In general, all you members are awesome, especially when you come to live streams and you put up some stocks that we can look at. So thanks so much for attending and being members. We move on to the next stock. What is next on the agenda? We're going to move over to BBWI, but I got to take a look at the chat real quick. Make sure I'm keeping an eye on things. It looks like David is here. I know you've been on before. I don't own any silver gold miners. Man, I kind of wish I had. They have kind of calmed down a little bit. I did notice them. Silver has calmed down. It's come down like in the last 2 months. Silver isn't doing as great. And gold even has had a couple of flat or even down days. So we'll see where that goes. Peyton's got a comment or question here. You know, Futu has its own chart. You'll see Futu just explode on some days. You're like, where'd that come from? And I think that we should expect that. If they keep putting up great numbers, the rest will take care of itself. I think it's a surprise that it sold off, but it was a down day. And on a down day like this, where you see the Russell down 1.6, right? Futu is a smaller business. It's international. It's not Walmart. It's not Costco. It's not, Amazon. Everybody knows those businesses. It's Futu. Not a lot of investors know about Futu. And they're out of the US. So it just doesn't have that safety aspect to it. And it sold off. So it's not a giant surprise, but it's an opportunity. I'm going to buy some Futu stock. All right. Man, you guys are coming at me with comments. I am liking the action tonight. Any Latin American companies? I got TX, which is Ternium. They operate predominantly down in Mexico. They also have operations in Venezuela, Argentina. And I've covered PBR, Petrobras down in Brazil. I've covered New Holdings down in Brazil. So there's good companies in Latin America. I think the Latin American economy, and of course I have Mercado Libre. That's one of my stocks. And they're a terrific business. They're like a mini Amazon down in Latin America. Awesome. So there is good opportunities down in Latin America. Not a lot of them. Got to do our homework. Got to be really selective. And that's where I'll leave that. Gabriel, very good to see you, man. You want to go over Sprouts Farmers Market? I would love to, because I started buying some Sprouts Farmers Market, and I was able to buy it at the low, and my shares have gone up. More recently, the stock sold off, so I bought more shares. I bought more shares yesterday, and the stock was up nicely today. Man, stock investing is really fun at times, and I think Sprouts is going to enable me to show you when, it kind of feels good. Kind of like I'm not a very good golfer. I don't even golf all that much, but I've had the experience of hitting a golf shot, right. Just feels so good. It feels so effortless. You just hit the ball right and it flies and you're like, wow, great. Sprouts Farmers Market feels like that. It over the last couple months, it's set up really well. I bought the stock and boom, started performing. Man, it feels like a good golf shot. All right, enough of golf. We're here to talk about investing and not golf. I could talk about investing in stocks for hours. I could talk about golf for 5 seconds. All right. Crystal Biotech. And Crystal Biotech is a commercial stage biotechnology company, discovers, develops, manufactures, and commercializes genetic medicines to treat diseases with high unmet medical needs in the United States. The company commercializes, man, look at this word. I'll let you guys pronounce it in your heads. This is for the treatment of dystrophic epidermolysis. Man, you can tell I did not do really well in chemistry or life sciences. I did do really well in mathematics, finance, accounting, and economics and statistics. All right, so these guys are a biotech company. I like biotech. I've done well with some biotech stocks. These guys are, let's take a peek at their website just to get our heads around what is their business all about. I have looked at this stock before. Okay, so they have some medicines. Now, biotech companies, right? You have, let's get into their fundamentals, and then I'll give you my observation on this stock. Very small cap, $7.35 billion in market cap. Okay. And their forward P is 31.8. We'll see if that's a high PE or reasonable given on once we look at their revenue growth. Analysts think there is a discount. Over the 1 year, this has performed really well, up 36%. That's really good. Over the 5 year, up 197. Nicely done, Crystal Biotech, making investors wealthier by tripling their money over 5 years. That is getting the job done. Now they're growing at 33.95%. Looking at the quarterly, they're slowing their growth rate down. Now, this isn't the biggest company in the world. It's kind of small. Look at the compare here. So they moved 17% higher and they're small. So it's the growth is a little bit of a yellow flag. We saw that they had a higher PE and their growth rate is decelerating, right? We're moving from 36% down to 17%. Now, what you would need to study on this stock is what's their pipeline of drugs? Do they have some good drugs coming? Will they be putting a new drug into the commercial phase of that drug in the next year, 2 years, 3 years? Because that will really determine a lot of the value in this company. If they do have a pipeline and you see that, hey, they're going through the FDA phases successfully, this might be a good investment. But because the growth isn't all that great, it's okay, but for a small business, they should be doing better. Analysts have an 18% discount. This is a small cap, right? So I'd have to see a really good discount on a small cap to really be compelled to consider investing. And here's where their growth is being projected. So we are in this year, 2025. I'm curious here. So it looks like we've had 2 quarters of this slow growth, but now they're supposed to start growing faster. This growth does look really good going forward. 40% growth looks good. 35 looks great. 31 looks good. So this growth pattern looks terrific. Okay. If they can hit these numbers, this stock should do great. And you see the PE ratio is coming down fast because of this growth rate. So this stock's looking really good. So I like their growth. Let's take a look at their profitability. I forgot to check to see what kind of profitability these guys have. And since they're a younger business, I'm going to focus more on the top gross margin number, 94% gross margins. That's terrific. That tells me that they own the patents on the medicine or the pharmaceutical they discovered, and they have somebody else manufacture it, or they're licensing that particular formula to somebody to produce it, because they get to keep a lot of the revenue in the form of gross margin, net profit, and free cash flow. This is looking like a really good stock. This looks great. So now it's done great over the 5-year. It had a really nice run coming. I think they announced probably their forecast for 2026 around this time. They started to whisper it and investors bought into it. More recently, we've seen that this stock isn't doing all that great in 2026. And it's likely because a lot of stocks aren't doing well, right? We got a war going on. We have high oil prices. All that stuff is creating opportunity. That's what it's doing. It's lowering the stock price on terrific businesses. I really like Crystal Biotech. I think this is potentially a buy for me. I like everything I'm seeing. I like the revenue growth. Revenue growth to me for a biotech company shows that doctors believe this particular drug helps their patients. They're recommending it, they're prescribing it, and it's being sold quite a bit. These guys could be acquired. If they're acquired, you're going to immediately be paid a nice premium. This stock is a wealth creator. This is a good looking stock. It has very good numbers. It also has, those 2 quarters of lower revenue growth. That's enough for me to make sure that I would have to go to their investor website and research it. Make sure that I'm confident in what they're saying is going to come, how they're going to grow in 2026, 2027. Because if they grow at these numbers, this stock should perform really well. Over the next 2 years, it should continue to reward investors. So this is a good one. Very good nomination. Appreciate you bringing Crystal to the live stream. And these live streams, it's great. I get these nominations and we look at stocks. And this one here, if everything checks out, I'm probably going to buy the stock over the next 6 months or so. And I've made really good money from nominations on these streams. So I appreciate you bringing Crystal. It's a good stock. I believe I have a valuation. Let's take a look at, I've looked at Crystal before. It's just been a little while. Crystal Biotech. January 2nd, 40% discount. Looks good. From every angle, looks really good. All right, let's move on to the next stock. The next stock is Mike the Dividend Investor Guy's nomination, BBWI, Bath and Body Works. This is a retailer. They do women's shampoos. I think they're organic based, like body treatments and things for ladies. Over the 1 year, this is really beaten down, 37% down. Over the 5 year, wow, This is not looking good, folks. Very small cap, 3.8 billion. I'm curious to see, where are they classified? They're a consumer discretionary, specialty retail. Okay, that makes sense to me. We've got a market cap of $3.8 billion, revenue 7.3. All right, so it's a retailer, so that's kind of normal. P ratio is 7. Geez, talk about a discounted stock. 36% discount according to analysts. So we've got a business that hasn't been able to grow for 4 years. Last time they had a really good growth period was during COVID. Everybody was at home, pampering themselves and so forth. Quarterly, some quarters have been green, some have been red. So this business here, when we look at desirability of a business, let me open something up that I like to use just to make this point. So if you guys have watched my videos and my analysis, this is my desirability scorecard. And let me pop open or find their logo. All right. So we know what great business is. We know what some great businesses, for example, NVIDIA, Google Alphabet, those are awesome businesses, gold standards. But is this a good business? And a good business, I believe the desirability is determined by the strength of their moat. The moat is their ability to keep competitors out of their market. Because if they're successful in selling something at a really good price and making a lot of money, what they don't want is other businesses to be able to come into that market and start competing against them, taking customers away, putting pressure on their price, the product price, and then making those margins shrink because of competition. It's also represented by the actual revenue growth, the profitability. Does it have big gross margins or small? And the free cash flow generation. Now, our friends at Bath and Body Works, let's take a look at a few things that are going to help us score the revenue, profitability, and free cash flow. So here's their income statement. Starts with revenue, 7.2 billion. Got it. The gross profit, this is a retailer, and their gross margin is 43%. That's pretty decent for a retailer, FYI. Profit margin, 8.9. Again, fairly decent for a retailer. That's pretty darn good. Free cash flow, 11.6. Again, these are decent numbers for a retailer. These numbers look good to me. The number that is, I'm having a problem with is this growth. If you're not growing, it means your competitor is growing. It means your customer isn't excited about your product. It means not a lot of customers are, you're not getting organic new customers. You're probably losing some customers. So that line means a lot to me. Now I can scorecard these guys. So Bath and Body Works, competition. I can't say that they can fend off competition. So I'm going to give them a C. Network power. No, there's really no network power. I kind of know of this business, but it's not all that interesting. A balance sheet. Now, let me take a quick glance at their balance sheet. I forgot to look at that. And when I glance at a balance sheet, I'm looking at debt versus cash. They have 4 billion of debt. Debt to EBITDA is 2.76. That's fine. The balance sheet's good. They have a little bit of debt, but it isn't a big problem. So I'm going to give them a C. Revenue growth, D. Profitability, I'm going to give them a B. And cash flow, B. So score is in the red. Okay. And mainly because of this revenue growth. Okay. And red companies, I am really careful with. Okay. Because red businesses mean investors aren't just going to like this business. It could be a recovery story. Like, hey, you know what? Investors thought they were going to go bankrupt, but they didn't. And the assets are worth more than its current stock price, something like that. Well, that might be an investing strategy for some investors. It's not for me. I want to find businesses that I want to make money over the next 5 years with. I want them to double their value at a minimum over the next 5 years. And if I get involved with companies in the red, they distract me from my primary goal, finding great businesses, owning them, and expanding my portfolio's value. So this one here lands in the red. It's not a business that I want to buy into. I rarely invest in the red. I've invested in the red. It's a distraction for me. It's not worth it. My opportunity cost is too high. So I wanted to put that out there. This business, I could probably calculate a discount. Most definitely is discounted because it's being counted out. Investors don't want a lot to do with these guys. For these guys here, I'm going to jump into my valuation tool. I created this tool. It follows my investing methodology. It follows all the calculations that I put. And as you could tell, it's also secured. So it logged me out because I was not in the application, but now I'm back. So I'm going to put Bath and Body Works. We don't have any growth. So are we going to see any growth? I'm going to say we're going to grow maybe by inflation. Discount rate, I'm concerned with this business, so I'm going to go 8.5. Long-term growth, I'm going to go to 3. And then earnings per share, not really growing all that much, so we'll go to 3%. And I'm going to give them, man, I can't even give them a decent PE ratio because they're not growing. So when we do that, we have a discount. But it's just not, it's not a game I want to play. I don't want to buy a red company. I don't want to buy a company that's just really, it's just bumping along the bottom. So to some other investors, it may be an opportunity. I hope you make a lot of money on stocks like these. It's just not the right stock for me. It is discounted. So Mike, you asked about that stock. Those are my comments. You know, I'd love to find the next right company that has the right fundamentals. Like on this stream, we saw KRYS. That looked really good. United Therapeutics. That's another biotech company. It's done terrific. Those are the businesses that, man, those are so fun to own. So I'm going to play in that field and leave investments like BBWI for other investors to consider buying. All right, so we're moving to the next stock. The next stock is ACI. That is Albertson's companies. Now, Albertson's probably, I think it was about 3 years ago, Kroger wanted to acquire Albertsons, and the was it the SEC or Department of Justice at that time said, "No, we don't want you to buy them because it would rub out competition, yada yada." So it didn't happen. So Albertsons is pretty much running solo. They did want to merge with Kroger. It hasn't been a very good stock over the last 1 year. Pays a nice dividend, 3.5. And this is grocery. This year, Not a bad place to be. It's a pretty rough stock market out there. We got software stocks selling off like crazy. Financial stocks, if you're in the wrong financial stocks, man, they're getting smacked around. Groceries doing pretty darn good. But let's see if this one is a good stock. We're going to talk about Sprouts Farmers Market later too, by the way. All right, so Albertsons, $8.6 billion market cap company, revenue of $81.7 billion. PE ratio is only 7.44. Analysts think it's a buy at 32%. Stock has not been performing. It should be performing. This is a safety stock. For a while, looked good. April 14th, their next earnings announcement. So we're about a month away from that happening. Their growth is, they've been growing. They've been growing single digit. This is grocery business. Okay. We're not talking about, NVIDIA selling GPUs. And if they put up a solid single digit growth number, that's pretty good. That's pretty good. Overall, they are generating free cash flow. Looks good. Gross margins, 27%. That's grocery business. Okay. And their profitability is really low. All right. Can they afford that dividend? Let's take a look. Payout ratio is 39%. We're good. What about their balance sheet? Do they have a bunch of debt? And the answer is they do have some debt. And their debt to EBITDA is 3.3. That is above the 3 that I like to see, 3 or less. This is kind of a little bit uncomfortable, but not completely showstopper. But I would increase my discount rate on Albertsons. All right, so looking at the forecast for these guys, analysts think there's a 32% discount. We are in the year that is going to end February 22nd of 2027. It's supposed to be a flat year. Man, these numbers are really low. The earnings per share is, the PE ratio is really low. Earnings per share is growing. Top line growth isn't there. Now they're going to announce their quarterly number in a month. And they're going to announce this number. They're supposed to grow by 10%. That looks really good. So I don't get why there was a red number here. Interesting. Okay. I think this looks like a good stock. Let me see if I have a valuation on Albertsons. And FYI, when we have years like the one we're having, some stocks are good ideas to trade into, and then be aware that once we get out of this bad environment for stocks, I would probably sell some of these stocks. They'll be good for like a year. They'll be good for a year and a half. But then once we get back into growth mode, I'd want to take that capital and go chase the next stock that's going to become the next, Robinhood or Palantir. Because stocks like these would do well in a bad year, maybe go up 10, 20%, pay you a dividend. But then in future years, they'd probably just go, even Steven, like not have much of a return and pay you a dividend. Well, I'd rather have my capital in a growth stock when things are better. So here is Albertsons. Let's update this for Albertsons. Okay, so Albertsons has got slow growth. Discount rate's going to be a little higher, but not 8.5. We'll go to 8. Terminal value, I'm going to grow that by 3.5. Okay, and then the growth this year was supposed to be nice, so we'll go at 5. And earnings per share growth will go to 5%. The PE ratio will go to 12. And there's a discount. Yeah, I agree with the analyst. I think Albertsons looks good. I own 2 grocery stocks. And if you count Target, that would be 3. Um, if you count Amazon because they have Whole Foods and so forth, that would be number 4. But I own Kroger. I own Sprouts Farmers Market. Grocery stocks are pretty decent right now. I'm good with the grocery stocks that I have, but this one looks good. Not a bad idea, and it's not overly priced. Comparing this one to, let's say, a Kroger. Kroger's been doing well this year. So Kroger's up 20%. It's up 111% over the 5-year. Pays a small dividend, so it's a good one. And then we're going to go over Sprouts Farmers Market later, so I'm not going to steal my own thunder on that one. Okay, we're going to go over OWLT. That is Owlette. Owlette Inc. provides digital parenting solutions in the US, UK, internationally. It offers a digital parenting platform that provides real-time data and insights to parents. It also provides sock monitors, including DreamSock, a wearable infant health monitor equipped with pulse oximetry technology. So it can tell if the baby has plenty of oxygen in its blood. Looks interesting. I think I've run into this company before, analyzed it. So speaking for myself, my wife and I have raised 2 sons, and when they're little babies, boy, you'll basically spend all your discretionary income on them because you care about them, right? And this would be totally a product that, if it worked, I could totally see us buying it. So that way you can monitor it. In my era, we didn't have cameras coming out of our ears like we do today. But nowadays, of course, parents have all this technology to take care of their little babies. Good stuff. All right, so let me clean up my act here. Get back to this stock. So I understand their technology. Now, this stock really got hit today. They announced their earnings last week. Stock went down today. It's a small, tiny cap, micro cap, 152 million. And they're losing money. They don't make money yet. They're extremely discounted according to analysts. Look at that. They went up and then they came down. And now they're priced at $5.41. Low price stocks like that, FYI, it's kind of a caution, right? Investors will be like, whoa, why is it priced so low? It must be a risky stock. Things haven't gone well for them. And there's a lot of truth to that. So that's one observation I'll make. So what's going on with their growth? This growth looks pretty decent. Did they guide and say, hey, sorry, but we're not going to grow that well going forward? So overall, the growth looks pretty decent. Gross profit looks pretty good. It's about 50% gross profit. Negative cash flow. They're young, no big deal. Gross margin of 50%. That's pretty decent. They are losing a lot of money, but they're a young business. Maybe the balance sheet's the problem. Let's take a look. So balance sheet, no, they got 35 million in cash, 13 million in debt. So they have $22 million of excess cash. Let's take a look at their burn rate. What's their free cash flow? So they're at their current free cash flow rate, they can exist for 2 years, and they just have to improve their profitability, or they'll have to borrow money to stay alive or issue out more shares. Either one would be bad overall for their valuation. So one analyst covers them. That analyst thinks it's highly discounted. They're going to continue to grow and achieve profitability next year. This year, it's still going to be a small loss. And this business This is a really risky stock, but you know, it's your call. It's risky, but I think it's potentially going to work out. If these guys get profitable, if they get acquired, it's a big win for an investor because it's such a small cap. Now it's going to come with a lot of volatility. You know, this is not going to be a cakewalk. Look at that. It was priced at 140. Now it's at $5. Oh man, that is rough. So this one's going to be super risky, but it looks like there's enough positives in the fundamentals where I could see this business working. It's just going to be really risky. It could go to zero, but I think it has a chance to make it. So that is Owlette, small micro cap, plenty of risk to go around with that stock. Let's go over to CALM. CALM. Cal-Maine Foods. All right, you guys are bringing up a good number of safe stocks. Your head's in the game because this year is going to be rough. Let's take a look at some food stocks, see if we can wait out this terrible market. And we'll go back to nice growth stocks when the environment gets a little better. Cal-Maine Foods, together with its subs, engages in the production, grading, packaging, marketing, and distribution of shell eggs, egg products, and prepared foods. Company offers specialty shell eggs, including cage-free, organic, brown, free-range, pasture-raised, nutritionally enhanced eggs, as well as conventional eggs under the Eggs Lands Best, Land O'Lakes, farmhouse eggs, and so forth. So these guys produce eggs. All right. Man, look at that row of eggs. Incredible. So over the 1 year, we are flat. It looked like they peaked in August, sold off. 5 year, look at that. Doubled your money. That looks impressive. Look at this dividend, 9.38. Impressive. $4 billion company. Its revenues have been growing. Interesting. Although the last quarter, that's why their stock was sold off, is they had a bad quarter. They were on a pretty terrific run, and they had a bad quarter. Let's look at the forecast in a little bit. Where are these guys headquartered? So they are headquartered in Ridgeland, Mississippi. Very cool. Okay, so they had a bad quarter. Let's take a look at the forecast, and we'll look at the balance sheet. 4 analysts are covering them. They think they're fairly priced. The stock overall has performed well. For some reason, we have a negative forecast. We've got it. This year that we're in is going to end at the end of May, and then it's expected the year after is going to have a contraction. Interesting. So why are their sales going down? Are people not buying eggs? Is the price of eggs going? Yeah, that might be it. I remember when we had those inflation problems, right? The price of eggs went really high. I remember like a carton of eggs, a dozen eggs was like $8. I remember my mom, she found somewhere they were selling them for like $6. So she bought like 10 dozen. She was calling the family, "Hey, I got you 2 dozen eggs." It was like, dealing in a rare commodity. So now that we have egg prices that have come down, these guys are struggling. So I think this is going to be a problem for them because there's not going to be a whole lot of excitement around their company. Lower revenue, lower profit. This is pretty spooky. It's treacherous. So I like being in Kroger because you're in food, but you're diversified, right? You're not like, well, if egg prices are either going down or up, it doesn't affect you as much. And, you pick the food category. Once you go strictly eggs, you're either going to make a lot or you're going to lose a lot. These guys were fortunate to be in the egg business when egg prices are really high. It wouldn't be an investment I'd want to make because, like with food stocks, I consider them as a safety stock. These guys have no debt, very good, and they have cash, very good. But these guys are not a safety stock because they're just a single category of food company. So you see that we've had some really good run ups, but now they've had a really good sell off because egg prices are not very high. So this one would be a pass for me because it's not fitting into one of the categories for me. But let's do a quick valuation. It's going to be a tough one because they have a contracting business. All right. CALM. All right. So from a revenue standpoint, okay, free cash flow, we're going to grow by 3%. And discount rates, a little risky, single product company in the food category. That's fine. Earnings per share growth, not so much. All right. And it looks like there's a big discount because their fundamentals were coming off a really good fundamental run. Like they were doing really well with their egg prices and so forth. And my applications taking historic data, I'm just not convinced that these guys are going to do well going forward. Their forecast doesn't look good. So calculates a discount, but I think investors are thinking, if you look at the last 3 months are flat. Year to date looks good. This scares me. So, but maybe you're picking something up that's worth owning. For me, I'm afraid of this forecast. If this forecast is happens, I just can't see how this stock's going to perform well because there's going to be a lot of negative quarters. Our revenue went down by 10%, 15%. So that's my feeling on it. All right. So bear with me. I'm going to go grab my phone. I think I just got a message. I want to make sure it's not my wife. I'll be right back. All right. Everything is good. Let's move on to Sprouts Farmers Market. So Sprouts Farmers Market was a faster growing grocery company. And for a while, it was doing really well because it was growing faster than its rivals. But over the last year, it was really selling off. But I looked at the fundamentals. It was on a live stream. And I thought, it looked good. And I started buying here. And now it's doing well. Excellent. I love it when that happens. Now, here's what's going on with Sprouts Farmers Market. It's a smaller cap. If you look at Kroger's pretty substantial size. And of course, like Walmart does grocery now, they're $1 trillion market cap company. So this is a small cap, smaller PE ratio of 14. Analysts think it's discounted. It doesn't pay a dividend, which is fine for me. The growth is more impressive than if you compare them. Like we saw Albertsons earlier, that was like 1% to 2% growth. These guys are growing at 7% for the last quarter, which was a bad quarter. But if you look at their forecast, that's where the money's at. You got to look through the windshield, and the growth looks good. 7, 9, 12. These growth numbers look good in the future, which is why I started to buy the stock. The profitability is going to expand. And the PE ratio looks really good. So Sprouts Farmers Market right now, right? Sprouts Farmers Market is not a grocery chain that has big stores with every product you can think of. in there. No, they have smaller store footprints. They have more of a prepared food, healthy, organic food kind of catalog. And to me, it reminds me of Trader Joe's. Trader Joe's is privately held, but if you've shopped at a Trader Joe's, you know what I'm talking about. Sprouts Farmers Market, Trader Joe's, the two remind me of one another. And I shop at both, but that's my feeling on it. Um, and when I value Sprouts Farmers Market, let's take a look at that. I've got a full valuation on these guys. I have a 35% discount. So I just saw a business that, you know what, it's looking good going forward. It's in the right category. Started investing maybe about a month ago. And so far, so good. I still buy shares. I think on Sprouts, we had a sell off. Thank you, stock market. I can use some more Sprouts Farmers Market stock. So I bought more shares. Bang. It went up 4.6. Excellent. I'll take it. So this is a good stock for me. I already own Kroger. These guys are smaller than Kroger and they're growing faster. So right now, having some safety stocks, not a bad idea. It's actually a good idea. Let's wait out 2026 like we had to for 2022. And then we'll get better stock conditions maybe in 27. But for now, this year is shaping up to be a tough one. I mean, if you haven't observed that, you haven't noticed the high oil prices, you haven't noticed the war, it's going to be a rough year. So let's get through it by making the right investing decisions. Now, Sprouts, would I hold this stock forever? Probably not. If they continue to improve their business, yeah, I can hold them for a couple of years, but maybe in a year's time, I might sell this one, make some money, sell it, and have some capital ready to buy into some high growth tech stock or biotech stock or communication services stock. So Sprouts Farmers Market, good one. All right, man, we covered a lot of ground. We had 12. Let's see here. We got 2, 4, 6. We covered 8 companies. We covered Bed and Body Works, Adobe, Futu, Crystal, Albertsons, Owlette, CALM. Forgot what they were called. Cal something. And then Sprouts Farmers Market. So, man, we covered all those stocks, got into them, got into fundamentals to understand what kind of businesses they are. But remember that fundamental analysis is part of the analysis of a company. You also have to look at the business high level, right? Make some qualitative decisions. You know, is that a business that is likely going to do well going forward or struggle? How do they do against their peers? You know, the moats, the revenue growth, and so forth. Looks like Mike is on. He wants to look at ELF. Let's take a look at ELF. And Mike, I covered BBWI. And you can look at that on the replay. And it looks like you're interested in Devon Energy. And I'm not selling any of my energy stocks. I'm looking to buy more energy stocks. I'm doing some homework on energy stocks. I'm going to create a video on oil stocks. And I found one that I think I'm interested in. You can watch it on the video later. All right. So enough talking. Let's get to ELF. ELF Beauty. Now, ELF Beauty is a consumer staple, huh? I wouldn't have thought it was a consumer staple, but I don't wear makeup, so I'll leave it up to somebody else to put it in its proper category. $4 billion market cap, $1.5 billion in revenue, forward PE of 22, discounted according to analysts. Over the 1 year, this has gone up and come down. Over the 6 months, not a pretty picture. All right. What does the last month look like? year to date. So it's kind of had a rough time for the last 2.5 months. It's had moments when it really rallied higher and it's come down. It announced earnings on the 4th of February and the market sold it off. And then it bought into it. Interesting. Looking at their financials, the growth numbers look pretty darn good. 16.7. Looking at the quarterly, the last quarter looked pretty dynamite to me. 37.7. That's pretty fast growth. These cosmetic companies tend to have good margin. These guys have terrific margins, 70%. Profit margin's a little low. They probably have to advertise a lot to be. In cosmetics, I notice it, right? That, geez, they have to advertise so much because I imagine ladies are always influenced by celebrities or influencers and are like, hey, I'm going to try that, makeup because this famous person's using it. And the cosmetic companies have to pay those famous people. So free cash flow, 14%. These numbers look pretty decent to me, starting with the gross margin. So there's potential there. Forecast. So we got 17 analysts covering them. They think it's a big discount. They're supposed to keep growing. 2026 is about to be in the books. Year where they are supposed to grow by 23%, going to 18, going to 12, and then to 3. Okay, so this does concern me a little bit. If their forecast is they're going to go flat like that, I don't think investors are going to want to buy this stock. I wouldn't want to buy a stock that's flat like this. So we're going to start the year that is represented here. It would be fiscal year 2027. We're going to start that year in about a month. Earnings per share is growing nicely. So these numbers look really good. It's these numbers that are concerning me. If you're going to go into a slow growth mode, we got problems. But where did these numbers come from, right? We only got 2 analysts commenting, so I'm not going to over analyze these numbers. I'm going to focus on these. These numbers do look good. Let's take a peek at that balance sheet. Make sure we don't have a ton of debt, which would be a recipe spoiler. 926 million, 196 million of cash. So we've got about $700 million of debt. They do have a debt to EBITDA that exceeds 3. So they got to improve their profitability. That is a risky balance sheet. So we got a risky balance sheet. The tail end of their forecast looks a little risky. They do have free cash flow. So free cash flow of 214 million. So beauty is not one of my strong suits. It is not in my circle of competence. And I remember Warren Buffett bought a beauty company, or I should say Berkshire Hathaway. I'm sure maybe one of his analysts made the decision on it. It would have to be a very clear understanding of what they do. And, if I was optimistic about what they were doing, these guys here, they do have kind of a risky balance sheet. So I'm going to leave that at 8.5. Terminal value growing at 3.5. That's fine. Their profitability was growing nicely. And PE ratio of 12. That's fine. So look at that. We've got a fair value on the green line. They traded up and then they came down closer to that fair value. They still have a stock price that's too high. Their free cash flow is pretty light. And their profitability is light, I should say. Their free cash flow is fine. So it's not the right stock for me. I'm not a beauty investor. I don't know if they're going to be successful or not. The numbers don't compel me to be an investor, for me to be a pass. So that's ELF. Devon Energy. Now that's an industry that I could get my head around. I worked at an oil company as an accountant. Graduated college, went to work for what is now part of Chevron. Good job, man. They were cool people there. Nice people, kind of an old school environment, totally old school. And had a good experience there. Devon is doing great, man. Up 34%. Year to date, making it happen. Devon Energy, ladies and gentlemen. These guys, they're exploring, finding oil, putting it to market, getting a better price. Oil prices are higher, paying a dividend. Everything looks good right now for oil companies. Market cap 28.6. So these guys are probably going to appreciate. Their stock price is going to go up faster than, let's say, a Chevron or an Exxon because they're smaller. Now, these forecasts, we're first going to look at growth. They grew in 25 quite successfully, 7.8. If you look at Chevron's number, it's not that good. So that's a pretty good number. And when we look at the forecast, these analysts probably have not had a chance to update their forecast, because I could assure you they're probably going to grow a lot faster than 8.5%. They're probably going to grow by like 30%. At least, I think I mentioned at the beginning of the stream, went from under $60 per barrel to above $90 per barrel. It's more than a 50% increase in the commodity price. That means that when Devon sells a barrel of crude oil, the price is increased by more than 50%, but the cost of producing that barrel is pretty much the same. It's identical. Just the price they get to charge is much higher. Oil companies become incredibly profitable during this era because they have operations that have been in existence for more than 100 years. They know what they're doing. They're very efficient at extracting oil, putting it to market, and making money. These guys are solid. Energy companies look good. I'm actually buying more into energy. I bought some more Oxy either yesterday or the day before. And I'm looking at the stock that I've got my lasers pointed at, Canadian Natural Resources. Everything looks good about these guys. And it's different than Devon. I'm going to get back to Devon. Devon looks good. Oxy looks good. Chevron looks good. Exxon looks good. Just the whole space looks good because oil prices are so darn high. You give me $96 per barrel, these oil companies become just cash machines. Just start cranking out free cash flow, maybe have some one-time dividends. Everything's good in energy right now. But they affect the rest of the economy, which is not a good thing overall. So these guys looks good. I think I have a valuation on Devon. Let's take a look. There it is, Devon Energy. Stock price has been going up. It's discounted by 10%. You get that dividend along with I think there's some better choices than Devon right now. Oxy is a good choice for me. Oxy's discounted by 35%. I'm doing great with Oxy this year. And Valero, not discounted, but here's Canadian Resources, man, 41% discount. These guys are up 200% over the last couple of years. And they do oil in Canada and they export it down here to the US. They also export to China, big consumer of oil. Well, hey, man, they got a big customer in China. They keep cranking out that oil out of Canada and selling it to China. There's nothing that's going to stop them, right? Especially now that China is probably having a harder time getting oil from the Middle East. And I know they get oil from Iran, but maybe some of that oil gets delayed. They can buy more from Canada. And they can buy it from Canadian Natural Resources. So there's some good choices in energy. I think Devon's fine, but I'm going to pick some other ones. All right. So you're looking to get back into ELF. Good luck. Awesome. Hope you make some money. So the ELF products are cheaper than See, I don't know that stuff. I didn't know if Elf was like expensive, cheap. I don't know. I don't know. But good luck with that. All right, guys. So we ended up covering a total of 10 stocks. That was a cool stream. I'm streaming in the evening now. That's really cool. Looks like DJ's got a comment. CNQ production cost is low. Interesting. CNQ. What are we talking about there? CNQ. Yeah. And their production costs are low. They have a lot of oil up there. A lot of their oil is trapped in sand, but they have a new technique where they can extract it. That's what's cool about innovation, right? Is you got a problem, you get some scientists into it, and they figure out a way to do it. So that's pretty cool. Thanks, DJ, for the added comment. Thanks, Mike. I appreciate it. Thank you very much, sir. And Mike and I, we are in contact on Discord. If you're a member, an advanced member or higher, you get on that Discord and we can chat throughout the day. Sometimes I'm really busy, so it takes a while for me to reply, but most definitely, if you get on that Discord, you can exchange ideas, get people's thoughts, see what other people are buying, selling, see what they're thinking about stocks. All right, let's shut the show down. And looking forward, do we have a pre-market number yet? Let's take a look. I don't think that's correct. Oil prices are still high. Let me take a peek at that price for Adobe. And it's still down a lot, man. Still bleeding out. But they had very good fundamental. They had really good earnings. Just their CEO is moving on, so maybe that's part of it. We'll see where it trades tomorrow. I wouldn't be surprised if it trades higher. So we'll see. All right, everybody. So that'll do it for tonight. I appreciate you joining. Really good stream. We had a lot of people on. I appreciate it very much. And all you members out there, really appreciate you very much. I will not be streaming tomorrow morning with Daryl. I'm going to be working on my mom's house, and I'm actually going to be there while somebody works on her air conditioning and heater and make sure that's all taken care of for her. And but I'll be back on Monday with Daryl, and I'll be back next week. I'll try to make Tuesdays and Thursdays, evening streams for the East Coast, work each week, and I'll try to stick to that schedule. It's been a while since I've streamed in the evenings. I've just been super busy, but my schedule looks better going forward. All right, everybody. Have a good night. Good luck with your investments. And remember, this market's tough, right? But don't let it get to you. Just keep doing your homework, your analysis. Have a long-term vision, because in 2022, I bought some terrific businesses that I made a lot of money on. Focus on that, which is some awesome businesses are going to be discounted. Now, let's not jump in head first, at the first signs that there's a sell-off. We got to be methodical, do our research, make good decisions, rinse and repeat. And we'll wake up 2 years from now wealthier. That's my feeling on it. So let's keep our heads up, keep doing our homework, and keep, buying great businesses. Everybody have a good night, and we'll talk to you next week.